Bajaj Finance is a stock in focus. The stock is about 3% higher. Strong quarter, as always, I would reckon, for the company. And we're joined by Rajeev, Jain, Managing Director at Bajaj Finance, on the phone line to talk about these numbers and the outlook ahead. Rajeev, so good having you. Thanks much for joining in. Neeraj here. Good afternoon. And congratulations on a strong quarter yet again.
Thank you.
Have you done anything different, or is it a continuation of what you have been doing for the last few quarters? Because the times are slightly different than what they have been in the last 3-4 quarters.
No, it's been all continuity, both on the asset side and given since September what's been happening to the external environment, continuity on assets and continuity on liabilities.
Okay, Rajeev, just wanted to understand the mindset right now before we get to the minutiae of the quarter. I reckon that the space is wide open for stronger companies to go out and increase their market share, loan growth, almost everything. And you've done what you have been doing for the past few quarters. Are you going a bit more prudent because of the times at hand right now, or is it something else?
I mean, we remain focused on look, it's been strong growth over the last few years. Last year has been a strong year of growth. We have to just continue to manage this growth. We have never chased anything, so we're not chasing market share at this point in time again.
Okay. As I look at the numbers, Rajeev, quarter 4 FY19, very strong growth. I presume all the segments, consumer B2B, B2C, rural, even SME has gone up on a YOY basis in a meaningful way. How are the trends looking like, and is this something that one can expect from the company for the better part of FY20 as well, or could there be a change? Because you are known to go slow in certain segments where you believe things could change over the next couple of quarters.
Yeah, so I mean, clearly, growth was reasonably strong across most, if not all, lines of businesses in the previous quarter and full year. At this point in time, we are finding that the risk continues to represent what we would like to acquire. So we remain in a growth mode. So the orientation remains at this point in time to continue to deliver to the shareholders over a medium term, a 25-27% balance sheet growth and a 23-25% net income growth within a 1.5% gross NPA corridor.
Hi Rajeev, good afternoon to you and congratulations on good set of numbers. To maintain the growth rates that you've been posting year after year, will you have to raise any capital now going into FY20?
We ended, the overall capital adequacy remains reasonably strong. We ended 31st March with 20.66% of overall capital adequacy. Tier 1 was at 16.2%. In general, we have gone out and raised in the last 8-9 years when we get closer to between 14 and 14.5. Our burn rate at this point in time is in general around between 35 to 50 basis points. There is some degree of seasonality in our growth. Our first quarter and third quarter are stronger. Second and fourth are relatively weaker. So my sense is sometime in the second half of the year, it may be the fourth quarter of the current fiscal or first quarter of next fiscal, that we would go out and raise capital from a 3-year standpoint.
Just a sense on cost of borrowing, and correct me if I'm wrong, I think for most of the players it had gone up. How did it pan out for a company like yours?
We entered the difficult liquidity environment, and post the IL&FS event, we were at 8.2% blended cost of funds. We have exited, we were at 8.3% in Q3, and we are at 8.3% even today. So we've been pretty steady. Okay,
and AUM growth of 41% for FY19, what sort of guidance do you have for FY20, and where do you see the majority of the growth, incremental growth, to come by in FY20?
We essentially see growth to be reasonably broad-based. I would foresee most lines to grow between 25-27%. At this point in time, we are very comfortable from a risk standpoint on most lines of our business. So you should expect granular growth, and you should expect growth corridor despite the environment of a 25-27%.
What about the housing portfolio, Rajeev? Would that grow at a slightly higher pace because the opportunity is right there? And if that would indeed be the case, should the street factor in some pullback in net interest margins?
Given that the entity is a new entity, it's only 1 year old, we are watching our back on liquidity, given that it's a new entity and a new company while it's 100% subsidiary. So growth could be stronger given white spaces in the mortgage market, but we are watching the liability side in BHFL before we accelerate asset side growth. So if it was not for that, I would have exactly opined that growth would be stronger in the mortgage business.
Okay.
But given the new company, given the environment, we have to be cautious.
So NIMs will not necessarily see any kind of a big impact in FY20.
We remain committed to and I'm talking only medium term. It's difficult to, it's difficult to forecast near term, I would say. We remain committed to delivering between 3.3 to 3.5% return on assets and 18 to 20% return on equity.
Okay.
How much ever harsher the environment gets.
Rajeev, just a word on your provisions, which went up, I guess, for the quarter gone by 400 crore. And a word on that, if you could elaborate on those provisions and what to expect when it comes to provisions now going ahead in FY20.
Overall, our provisions should remain within a corridor of 1.3 to 1.5% of average assets. If you see, our average assets were 100,000 crores last year, and our overall provisions came in at 1,500 crores. You should expect to see them between 1.4 to 1.6% of average assets. That's really where we have been over the last few years. So we don't see that corridor changing.
Okay.
It could go to 1.6. It may come back to 1.4. 20 basis point plus minus is really what the forecasted view would be.
Okay, Rajeev, last couple of questions from my end. One, somebody was mentioning about how FY20 could show evidence of how even if the customer growth addition numbers might be lower, the book growth would be considerably faster, 1.5 times to 2 times the customer addition pace. Is that a reasonable estimate, or are you not looking at those statistics right now as much?
No. We remain a growth company. New customer acquisition remains important for us. We last year added close to a tad below 8 million new customers. I would think we will continue to, given the geographic footprint that we continue to invest in. We are in 1,800 cities at this point, 1,830 cities in India. That will get to 2,000 to 2,050 cities in India and towns in India. You should see anywhere between 5 to 7 million customers addition in the current fiscal.
Okay, one question on the industry, Rajeev. I remember a conversation that we had about 6 to 9 months ago, wherein you mentioned that the current scenario back then was not looking like 2013. 9 months have passed since then. Has your opinion changed about how the industry and the liquidity situation is looking right now?
Yeah, it's seeming much more structural is all I would say. It's obviously not transient because the last two crises got resolved in 50-55 days. It's looking a lot more structural, and there'll be structural actions that will be required to resolve this. So one has to remain cautious.